World Bank and Chief Economist of the World Bank. Justin Lin really requires not that much introduction, but let me use a couple of words that I have used on a previous occasion where I introduced Professor Lin. This was about a year ago when he was here last, and one of the things I said was that the world can be happy that we have a chief economist such as Dr. Lin in the World Bank. This was in response to another comment made that the World Bank should be happy that they had a chief economist like Justin Lin, so I thought we should broaden the perspective. Justin is going to speak today on a topic that concerns all of us. China is incredibly important, and for those of us who work within the area of development economics, we follow China and we have been impressed by the major progress that has been made over these past few decades. It is really impressive. But there are, of course, also challenges and remaining challenges, and there is a particular background to this experience. It is therefore a great pleasure that Justin is here to help us understand and demystify the Chinese economy. We have in WIDER been fortunate to be collaborating with Justin over the past year. And in addition, of course, to noting that Justin is a world-renowned scholar with a long list of publications on China, I should say that he did the WIDER annual lecture in Maputo, Mozambique earlier this year. And there was an audience of about 400 people, and we were really proud that we were able to put that together in Africa for the first time. Justin came up with a very exciting title, From Flying Geese to Leading Dragons, and I would encourage everyone to read that. It is a very insightful analysis of opportunities and strategies for structural transformation in developing countries. But today focuses on demystifying the Chinese economy. Welcome, Justin. The floor is yours.
Thank you very much for the nice introduction, and it's quite a pleasure for me to come back to WIDER and to meet the colleagues here and to discuss with you one of the most striking phenomena in the modern economic history. I think that is the rise of Chinese economy in the past 30 years. We know that China started the transition from a planned economy to a market economy in 1979. And since the start of the transition, the average annual growth rate in China has been 9.9% per year. And that means that in the past 30 years, the size of the Chinese economy increased 17.6 times. And in terms of per capita income, it increased 12.3 times. And this was not expected by anyone. We know that the transition in China was under the leadership of Deng Xiaoping. And when the transition started, the target he set was to quadruple the Chinese economies in 20 years. And I'm translating into his target of the economic growth rate in China was 7.2% per year. At that time, I was a graduate student at Peking University. And I did not expect for China, with a population of over 1 billion. And at that time, 80% of the population was in rural sectors. could have such a high growth rate of 7.2% per year continuously for 20 years. So at that time I thought it was just a high target to motivate the Chinese people to work hard and to do the best. And even China could not achieve the high target of 7.2% per year. If China can achieve 6% per year, that would be remarkable. But in effect, retrospectively, even Deng Xiaoping was too conservative because the actual growth rate, as I mentioned, has been 9.9% per year. And the difference of 2.7% per year continuously for 30 years, it was, unimaginable. Because if China grew at 7.2% per year continuously for 30 years, the Chinese economy would have increased 8 times. But as I mentioned, in effect, now it increased 17.6 times. And in this process, it was not only a high growth rate, it was also a process of opening up the Chinese economy. When China started to reform in 1979, China was an inward-looking closed economy. And one measurement was the trade, both export and import, as a percentage of the Chinese economy. And like all the socialist countries, at that time, the trade was not important at all. So the trade-dependent ratio, import plus export, its percentage of Chinese GDP was only 9.5%. But during these 30 years, the growth rate of Chinese trade was 16.3%. 16.3%. And as a result, the trade in China increased 105 times. 105 times. And the trade-dependent ratio increased from 9.5%, and now is 65%. And among the large economy, my definition, is an economy with a population larger than 100 million. Chinese economy was the most open economy because, like US, the trade-dependent ratio was less than 25%. Japan is only around 20%. And China's trade-dependent ratio now is 65% of the Chinese GDP. And in these 30 years, China turned from a low-income agrarian economy now into the largest industrial producers in the world, the largest exporter in the world, and the second largest economy in the world. And in the past 30 years, 600 million people get out of poverty. We know that the Millennium Development Goal, the first target was to reduce the number of poverty by half compared to the level in 1990 and by the time of 2015. China alone met that target, achieved already, because of 600 million people get out of poverty. And this is beyond any people's expectation. So recently I tried to publish a book called Demystifying the Chinese Economy, and that will be published by the Cambridge Universities, sometime in October, November this year. In this book, I'd like to answer 5 questions. The first one, why it was possible for China to have such an unexpected result. That's one thing. And the second question, why before 1979, the transition started, it was impossible for China to have a similar economic performance. And for the first one, my answer is very simple, that to follow a country's competitive advantages in order to tap into the advantage of backwardness, it would be possible. And for my second question, the answer was also simple, because before the reform in 1979, China did not tap into the advantage of backwardness. And if the answer is so simple, then the third question is that, why not other transitional economy, like Russia and like Eastern European country, and also many other developing countries, in their process of transition or reform, they could not have similar economic performance? That's my third question. And my fourth question is, well, China achieved such a dramatic economic performance, but everything has 2 sides. And what are the costs that China paid for its outstanding performance in the past 30 years? And my last question is that, will other developing countries can have a similar performance as China in the coming years? And I talk about that in my wider lectures, but I'd like to repeat some of the message here as well. I think that the first question for me, as someone working on economic development, we know that economic development for any country, certainly it's a process. It's a process of continuous technological innovation, improvement. And it's also a process of continuous structural transformation, moving the resources from low value added sectors to higher value added sectors. That is so-called industrial upgrading. Economic development is a process of the phenomenon. And according to the research by historians, we know, before the 18th century, the economic development in any country in the world was very slow or even unobservable, because the empirical data show before 18th century, even on the Western European country, now the advanced country, before 18th century, the average annual growth rate of per capita income was 0.05% per year. 0.05% per year. That means what? It took 1,400 years to double per capita income. 1,400 years. And after 18th century, it increased 20 times from 0.05% per year to 1% per year. Started in England and so on. And that means what? It took about 70 years to double per capita income. And by the time of 19th century, 20th century, the rate doubled again into about 2% per year. And that means what? It took about 35 years to double per capita income. In the nowadays high-income country, like in Europe or in North America. But for developing country, there's something called advantage of backwardness. Because we know the dramatic changes in per capita income was made possible by industrial revolution, accelerate the rate of technological innovation, and also the structural transformation I just mentioned. But for the high-income country, they are on the global technological frontier as well as industrial frontier. And for the high-income country, if they wanted to have this kind of technological changes or industrial upgrading, the high-income country required to do the innovation by themselves. For high-income country, innovation means invention. And I'm sure for people like you know, those kind of innovation or invention are very costly. You require huge capital input and very risky. The chance of success will be very small. And so that compared to pre-industrial revolution, most of the technological changes comes from experiences. It was by accident. After the Industrial Revolution, it was an intentional effort. So put more resources, more effort, you can have a high rate of growth in technological changes or structural transformation. But again, you need to bear high cost and high risk. But for a developing country, they are within a global technological frontier, industrial frontier. For developing country, technological innovation or industrial upgrading has some kind of different mechanism by technological borrowing, imitation, licensing, and so on. And by that, they can dramatically reduce the cost of innovations. And the empirical evidence show if low-income countries knows how to tap into that kind of advantage of backwardness or latecomer advantages in this innovation or upgrading, they can achieve 7% or more of annual growth. And we know that there was a report by the Growth Commission chaired by Michael Spence, the Nobel Prize winners. And to find after the Second World War, there were 13 economies in the world after the Second World War. They achieved 7% or more annual growth rate continuously for 25 years and more. And that was because of that advantage of backwardness. By tapping into the mature technology made available by advanced countries in their process of technological innovation and industrial upgrading. And China was able to achieve such a dramatic growth rate after 79. It was because after 79, China started to tap into that advantage of backwardness. Then the question is that if advantage of backwardness can enable a country to have such a remarkable growth rate, how come before 79, China did not have a similar economic performance? And my answer is very simple, because China did not tap into that potential. We know that before 1979, China was a planning economy. And not China, actually, after the Second World War, most countries follow strategies trying to develop similar industries as in a high-income country under the concept of heavy industry-oriented development strategies, or the so-called import substitution strategies promoted by the development thinking at that time. And I think the intuition seems to be right, because if you want to be a high-income country, you need to have a similar industry as in a high-income country. So the intuition seems to be right. And, but the issue is that the kind of attempt are too ambitious. For example, in China, starting in the first 5-year plan in 1953, the goal was to leapfrog United Kingdom in 10 years. In 10 years' time, China hoped to leapfrog, to develop something even more developed than the United Kingdom in 10 years' time. And also to catch up the US in 15 years. And because those kind of goals, certainly, China needs to develop the most advanced industry in the 1950s. And I think those most advanced industries, they are still under the patent protection, right? So China could not borrow, China could not imitate, China need to reinvent the wheel to bear the same cost and risk. That's one thing. Secondly, more fundamentally, those industries were very capital intensive. But at that time, China was a low-income agrarian economy. If you look into the endowment structure, China's economy was very scarce in capitals, relatively abundant in naval resources, and a little bit of natural resources. So that means that those kind of development strategies not only would not allow China to tap into those kind of advantage of backwardness, but also because of the priority sectors when against the China's competitive advantages. The firm, the enterprises in those kind of sectors are not viable in open competitive market. They are not viable. And if China wanted to develop those kind of industries, China need to provide the subsidies and the protections to those firms. The government need to mobilize resources to make investment in those kind of sectors. Once they are set up, the Chinese government need to continue to provide them protection and subsidies. And the way to do those kind of resources, mass mobilization, and also continuous protection and subsidies, was to give the firm monopoly in the market. And also to subsidize them with all kind of price distortions. Reduce the cost of interest of capitals, as well as overvalue the Chinese currency, and and so those firms can continue to operate. And as a result, certainly there's some kind of misallocation of resources, as well as repression of the competition and incentive. Not only so, those kind of distortion and subsidies become a source of so-called soft budget constraints. Because if firms did not operate well, they can come back to the government to say, well, you did not give us enough protection and subsidies. And they will argue for more protection and subsidies. And so the budget is not hard. And that was the reason why, before the 79, under those kind of old strategies, although the intention was good, but the economic performance was very poor. And if that was the reason that China did not perform well, then we can easily see, after the reform in 79, China started to deviate from the strategies. China started to develop sectors which are consistent with China's comparative advantages. That was the labor-intensive sectors. And that was the reason why China can expand its export so rapidly. Because the goods with labor intensities, China had a large, abundant labor force at a low cost. And Chinese product became very competitive in international markets. And with that, China grew very fast, and then accumulated capitals. The endowment structure changed from relatively scarce in capital, abundant in level, to relative abundant in capital, relatively scarce in level, and China upgraded industries to more technologically intensive, capital intensive industries. And in this process, it was a step by step. It went into sectors which are more capital intensive, new to China, but it was mature in global technological spectrum. So China could tap into the potential of the advantage of backwardness. And that was the reason why, before the reform, China could not perform equally well. And that was also the reason why, after the reform, China did so well. Then the question is that, if the reason why China did not perform well was China wanted to win against the competitive advantages. And we know that it was a common strategy for all the socialist countries, as well as for almost all the developing countries since the Second World War. And we know that almost all the socialist countries started to do the reform in late 1980s, early 1990s. And for other developing countries in Africa, in Latin America, in South Asia, they also started their transition, their reform in the 1980s or early 1990s. But they did not perform equally well. In effect, if you look into their growth rate, for other transitional economy or reforming economy, their economic growth rate in 1980s, 1990s, compared to their economic growth rate in the 1960s and 70s, in effect were lower instead of higher. And if you look into their macro stabilities, in the 1980s and 1990s, they even have more volatility in their macro economy compared to the 1960s, 1970s. And that's the reason why some economists like, Bill Easterly call the 1980s, 1990s was the lost decades for the developing countries, for the transitional economy. If the roots of the problem was similar, how come China could have such a dramatic performance? And during the same transition process, other economies performed even poorer than the 1960s, 1970s. I think it was because of the approach to the transition was different. We know that in most of the transitional economy in Eastern European countries, or in other developing countries in Latin America, in Africa. Their policy follow the Washington Consensus, follow what's called the Big Bang or Sharapi approach. WIDER has a division studying transition, you know that very well. And again, the intention is good for this kind of approach. What they see is that when this kind of reform or transition started, we saw all those poor performed countries. They have a lot of distortions in their economy. They have a so much constraint in their economy. They have inefficiency. And also, under the understanding at the time, if you wanted to have a good performance, you need to allow market to work. So you should remove all those transition, all those distortion in the price sectors. And so they propose to liberalize all the price, marketization. And again, if you wanted to have an inward-looking economies and would not allow trade to work, you cannot tap into the potential of backwardness. And so they recommend liberalization of their economy. And they also observe most of those countries have a lot of state intervention in the property right and so on. And as they recommend to privatize, otherwise they think that you cannot solve the issue of supply constraint. So the recommendation was privatization, liberalization, and maintain macro stabilities. I think the intention was right. However, this kind of approach, forget one thing. That is, all those kind of distortion, from my understanding, were endogenous to the need of protection or subsidize for those non-viable firms. I mentioned that a lot of firms in the priority sector, in the heavy industries, went against their competitive advantages. And since they went against their competitive advantages, in an open, competitive market, they cannot survive. And the reason why you have so many distortion, it was not, come out of blue. It was a necessity to protect them. And so if you follow Washington Consensus, did not try to address the viability issue. Either you will make all those enterprises collapse. And in developing countries, and especially in the transition economy, those kind of sectors were the dominant sectors. It employs 30%, 40%, 50%. In some countries, can even 70% of the workers in those kind of sectors. If we remove all those protections, they will go bankrupt immediately. And if you have economies with 30, 40, 50% of workers immediately lose their job, can you maintain social stability or political stability? Certainly you cannot. And without those kind of stability, how could you have economic growth? And in many other countries certainly would not allow those, and actually in transition economy, I did not see any country would allow those kind of sectors to go bankrupt immediately. And since if you would not allow them to go bankrupt immediately, you need to continue to give them some kind of protection or subsidies. But the new protections and the subsidies will be even more disguised than it used to be. Use economic jargons. The original protection or subsidies are second best. And now you went into some kind of third best or fourth best because they are even more disguised, more inefficient. And in effect, not only they are less efficient. They will be even more costly. I can give one analysis that is so-called soft budget constraint. Yes, before the transition, most of those firms were owned by the state. And the manager of the state-owned enterprises certainly had the incentive to bargain for more protection and subsidies. But they are state employees. They could not directly pocket those kind of protection or subsidies. And after the privatization, those firms now became privately owned and by some oligopoly. And they were in sectors which went against their competitive advantages. Without protection, they could not survive. And for two reasons. One, as I mentioned, employment reason. And the other reason, they were in sectors considered as the advanced sectors for the economy. The state would not allow them to go bankrupt. But the private owner, they did not have incentive to subsidize the state, right? They will continue to say, well, we cannot survive without protection or subsidies. So they would have some kind of rent seeking. They would bargain with the government to provide them subsidies. But this time they are privately owned. The more subsidy they received from the state, the more they could pocket into their own wealth, right? And you compare to the incentive structure. You know, under private ownership, the incentive to bargain for subsidies will be higher. And in effect, if you look into Russia, the subsidies provided to those kind of oligopolies, in effect, there are a lot of empirical evidence to show, were even higher than they used to be. And I think that the reason why the Washington Consensus did not work was because they did not address the issue, the root causes of those kind of distortion. And how come China could do so well during the transition process? The way China did that, China engaged not in this kind of shock therapy. China adopted certain kind of dual track approach. On the one hand, continue to provide some protection and subsidies to the old industrial sectors, and only do some kind of marginal changes to improve their incentive, but did not remove those kind of state ownership or protection immediately. It introduced a little bit competition, allowed the manager and worker to sell some of the property called the property retention system, but state continued to provide some kind of subsidy and protection. So that allowed the sectors, to continue to operation to avoid the collapse. But at the same time, China liberalized the entry into the non-priority sectors. In the past, those kind of sectors were repressed, like labor-intensive manufacturing sectors. In the past, were repressed. But after the reform, China liberalized the entry to that sector by the private sectors were foreign direct investment. And those kind of sectors were consistent with China's competitive advantages. So they grew very fast, very dynamically. And that's the way China achieved stability and dynamic economic growth simultaneously. And also because of the second track, market track, grows so fast, then certainly the endowment structure in China changes. Some of all the sectors in the past was not viable. Now because of the capital in China increased a lot, they become viable. So some of the older sectors now became very competitive. And if they continue to be inefficient because of the expansion of the market tract, create a lot of job opportunities. And so under the kind of situation, the government would afford to allow some of those kind of very inefficient enterprises to go bankrupt, because now there's a lot of job. And so you don't have to worry about the social stability issue. And that was the reason why China could achieve dynamic economic growth and stability during this transition process. But China certainly paid some cost to this kind of dual track approach. And the main cost is demonstrated in a lot of imbalances. The imbalances represent in the income disparities. Before the transition, China was quite an egalitarian society, measured by Gini coefficient. It was about 0.3, one very equal distribution country. But by the time now, 30 years later, the Gini coefficient in China reached about 0.47. And that was very close to the income distribution situation in Latin America. And that certainly caused some kind of social tension. And the second is that China had extremely high saving rate, investment rate. Consumption as a percentage of China's GDP become quite low. It's now only about 35–40% of GDP. And it's saving 55–60% of China's GDP. And the third one is the global imbalance. China has huge trade surplus. And as a result, the reserve accumulation was very fast. And now China has more than 3 trillion US dollars of reserve, the largest in the whole world. Those are the imbalances. And how come there's such imbalances during this period of time? I think it all related to the issue of dual track reform. In the dual track reform, as I mentioned, China continued to provide some kind of protection subsidies to the oil sectors. And one remaining distortion, was in the financial sectors. And in the financial sectors, it was concentrated by the big banks and the equity markets. And the reason why the financial system in China is dominated by big bank and also equity market was because before 1983, there was no banking sectors in China at all. Everything was allocated by central fiscal authorities. But in 1983, China started to replace the fiscal appropriation by bank loans. But in the past, fiscal appropriation was the way to subsidize the big enterprises. So when it transited to the big bank, the banking sector, it continued to provide the same function of the financial support. And a lot of those kind of sectors are big enterprises, right? And so the way to provide financial service to them certainly is the big banks. And not only so, the interest rate in China was artificially suppressed as a way to subsidize them. And this kind of way certainly allow those kind of large state-owned enterprises continue to survive and to operate. But as a result, small agricultural households and small and medium-sized enterprises, a lot of them are privately owned. They would not get any financial services. Although compared to the past, they developed very rapidly. But compared to the stage of development, their growth, their development was under-repressed. And this had two implications for income distribution. The first one was their interest rate continued to be repressed. And we know that only large enterprises and rich people have access to big banks and equity market. Since the capital cost was replaced, that means that they are receiving certain kind of subsidies, right? But who subsidized them? Lots of people put the money into the financial system, but without getting any financial services. In general, they are relatively poor compared to the rich people, compared to large corporations. And that's one source of the income disparities. And the second is that they also replace wages, right? If the labor-intensive sector develops relatively slow, that means the job opportunity will be relatively less. And as a result, the wage rate in China increased less fast. But we know that poor people, they gain their income mostly from wage earnings. And since the wage was relatively replaced, that means their income in the distribution of the wealth was also relatively replaced. And this contributes to the phenomenon. In China, you find the saving rate is very high. But in effect, household saving currently was only about 20% of the GDP. It was not higher than India or other developing countries. And the saving rate was very high was because corporate saving was very high. The corporate saving also contribute to about 20 or 25% of GDP. Then you plus, the government saving was about 10%. So that's the reason why China has such a high saving rate. And it was because of the transfer of wealth from the ordinary people, mostly to the rich people and large corporations. And we know large corporations and rich people, their consumption propensity is lower. And that contributes to that phenomenon. But it also contributes to the large trade imbalances. Because rich people and large corporations, they have high saving propensity. They make a lot of investment. But the consumption in China was relatively repressed. So domestic absorption was reduced. But you have a lot of investment, you accumulate a lot of production capacity. Domestic absorption was replaced. And the imbalance certainly will turn into the trade imbalance. And from this, we know that if China wanted to remove those kind of disparity in income or in the investment or in the trade imbalances, it's very important for China to complete the transition from the dual track to a single market track. And this kind of situation exists not only in the financial sectors, but also in the natural resources sectors. Currently, natural resources, like many other countries, is owned by the state. But the resources mining companies, they basically would not have to pay any royalty. It was a transfer of the natural resource wealth to them. And again, the reason was because in the transition process, it was a way to protect those kind of resources companies. And not only in resources, but also in the monopoly of certain sectors, like telecommunication, financial sectors. So if China wants to remove those kind of imbalances, it's very important for China to complete the transition from the dual track to the single track. With this kind of analysis, then my answer to the last question, can other countries perform equally well as China? I think potentially every country, every developing country should be able to grow at 8% or 10% continuously for 20, 30, or even more years. If they know how to develop their economy according to their competitive advantages. Then tap into the potential or advantage of backwardness. Because for the developing country, their industries and technological changes must be within the global technological frontier, industrial frontiers. So in the process of modern economic growth, the technological innovation and industrial upgrading can benefit from the mature technology and the mature industry that are developed in the high-income country. And if they follow their competitive advantages, they will be very competitive by definition. If you follow your competitive advantages, you will be very competitive in your domestic economy and also in the international markets. And if you are very competitive, you can earn a lot of profit and you can upgrade your capitals. And in this kind of endowment structure upgrading, if you upgrade your technology and industries, you can tap into the potential advantage of backwardness. And if those certain economies is studied by the Michael Spence, the Growth Commission, show that they can potentially grow by 7% or more for 25 years or more. And China's experience show you can also grow at 10% for now 30 years. Then I think that potential indicate every developing country in the world should be able to grow at 8 or 10% continually for 20, 30 or more years. But they need to follow their competitive advantages in order to tap into the potential of advantage of backwardness. But we also know, after the Second World War, almost all the developing countries, under the ideas of import substitution, were the development economics, the mainstream development economics at that time, all wanted to develop the modern advanced sectors in regard of actually they are poor agrarian economies. So they introduced all kinds of distortions. And so they have very poor governance, they have a lot of government intervention. Certainly those kind of things need to be dealt with. But in the process of trying to address those kind of distortions, we also need to understand those kind of distortions were introduced as a way to protect the modern advanced sectors in their poor economies. And you need to understand the roots of those kind of distortions. Even the intention to remove them is good, but you need to have a strategy of how to remove them. And the way to remove them would be something similar to China's dual track approach. In effect, all the successful countries in the transition process, they all, those kind of successful economies starting in Mauritius in the 1970s. Actually, the dual track was not invented by China. It was practiced by Mauritius first in the 1970s. In the 1970s, Mauritius, like other African countries, also have import substitution and protect their domestic manufacturing sectors. But in the 1970s, they started to use dual track. They set up export purchasing zone. Within the zone, it's free. But they continue to protect all sectors. And Mauritius became African miracles. In the 1980s, China adopted dual track. Vietnam also adopted dual track. Laos, Cambodia, they also adopt dual track. And again, they all achieve 8 or 9% growth rate. And even in Eastern European countries, like Slovenia, perform extremely well, and you could see Slovenia also adopt dual track. And Poland, in effect, it did not follow. Poland was the best performing economy one of the best performing economy in Eastern European countries. But Poland also adopted dual track. Poland did not privatize their state-owned sectors. It was introduced gradually, even up to the last few years. And other better performing transition economy all in the process, continue to protect all sectors and liberalize the entry to the new sectors. So I think that since all the developing countries, they continue to have those kind of distortions. And we need to understand the reason of those kind of distortions. So some kind of dual track, allowing the entry to the new sectors, but for the sake of stability and also allowing them to find a way to continue to provide necessary support to the all sectors will be necessary. If they can do that, they can achieve stability and dynamic economic growth simultaneously. And if the developing country can do that, I'm sure the dynamic economic growth, especially in the world economy today, will give them a lot of opportunities. And in my wider lectures, I show, if China continue to grow at 8 or 9% in the coming 10 years, a lot of the sectors very labor intensive in China today because of the increase in the wage rate. China will lose competitive advantage in those kind of sectors. And when China loses competitive advantages in those kind of sectors, then they can be relocated to other low-income countries. And China today employs about 85 million workers in the labor-intensive sectors. In 10 years of time, those need to be relocated. And Africa today only employs about 10 million workers. So that will be enough to triple, quadruple the modern manufacturing sectors in the African country. And if they tap into that opportunity, I think African country can also be another growth miracles like East Asian economies. So let me stop here and welcome your comments.
Thank you very much, Justin, for not only